My name is Luke, and I spent 3 years working at a strategy consulting firm before founding Essentials Explained. In this video, I'm going to lay out the key frameworks you need to understand to pass a consulting case interview. The most basic framework you will use in consulting is the profitability framework, which is simply that profit is equal to revenue minus costs, with revenue being money you earn, so sales or income, and cost being money you spend, or expenses that the business incurs to earn revenue. Within revenue, we can segment this into price and quantity, which is the price you sell a product for and the quantity of that product you sell. So if we have a really basic example of a lemonade stand, we can think about our price as $2 per cup of lemonade and our quantity as the number of cups of lemonade we sold. So if we sell 10 cups of lemonade at $2 each, that equates to $20 worth of revenue. Companies typically have several business segments that comprise their revenue. Business segments or business units typically equate to different products that the company sells at different price points and different volumes of those products. If you think about auto manufacturers, think about Tesla. Think about they have the Model 3, the Model S, the Model X, the Model Y. They're all priced at different price points and sell different quantities accordingly. They all have variable profit margins depending on the individual product. So back to our lemonade example, we could have our base lemonade product, which is $2. We could have our low sugar lemonade, which is sold for $3. And then finally, for those of you that are particularly acid intolerant, we have our premium organic alkaline-based lemonade, which retails for $5.50. Moving on to our costs, these are typically thought about in two main buckets: fixed and variable costs, with fixed costs not changing due to the quantity sold of the business, where variable costs increase with volume and are tied directly to the quantity sold of the business. Fixed costs may be insurance, administration, or rent or property taxes that are typically fixed, where variable costs are raw materials, labor, or applied overhead that contributes directly to the production process and varies with the quantity sold of the business. If we go back to our lemonade stand example, our fixed cost could be the cost it takes to make our poster to advertise for our lemonade stand. And that could be $10, and that will not fluctuate based on how many cups of lemonade we sell. It will cost us $10 if we sell 1 cup of lemonade or if we sell 1,000 cups of lemonade. The cost to make that poster is the same regardless of the volume. And then on the variable side, what we have are the ingredients to make the lemonade. So if it is a powder, or if we buy the lemonade directly from the store, what is important is that for every product we sell, our cost to manufacture the lemonade, either to mix it up or to serve it, goes up, and our variable costs are directly tied to the quantity or the volume of the business. So if we go back to our original framework with price multiplied by quantity minus fixed and variable costs, we can rewrite this as the price per unit multiplied by the quantity minus the fixed costs plus the variable cost per unit multiplied by the quantity, which can be rewritten to understand that profit is equal to the price per unit minus the variable cost per unit multiplied by quantity minus fixed costs. So our price per unit minus our variable cost per unit is also referred to as the contribution margin, or the profit contribution for 1 unit of sales. One very common question during case interviews is to calculate the break-even point, which is the quantity where profit is equal to 0, the amount of quantity where the business would earn exactly $0 of profit. So in our lemonade stand example, we have a price per unit of $2, a variable cost per unit of $1. We are trying to determine the quantity so that we can account for our $10 of fixed costs, or the price to build our poster. The easiest way to solve these problems is to rewrite the equation so that quantity is equal to fixed costs divided by the contribution margin for your product. So in this example, we have our quantity of X equal to our fixed cost of $10 divided by our $1 contribution margin. This math implies that we need to sell 10 cups of lemonade to break even in our business endeavor, and that we need $10, or the contribution margin of each product is $1. And if we sell 10 of those, we make $10 minus our fixed costs of $10 to generate the poster has us break even, and that we generate $0 of profit. This is a simplified example for a lemonade stand, but every business has a break-even point. If you think about a YouTube business that has some kind of fixed costs, which are their equipment they purchase, and then a contribution margin, which is the monetization of each individual video, you could say that a business that spends $1,000 on fixed costs has a contribution margin of 1 cent per view, which is roughly $10 per 1,000 views, would have a break-even point of 100,000 views, as it is the fixed costs of $1,000 divided by the contribution margin of 1 cent per view. A very simplified example, but intended to illustrate the mechanics of calculating the break-even point for a business with fixed costs and a fixed contribution margin for a single product. The last idea to understand is our profit margin. Profit margin is equal to our profit divided by our revenue, or the percent of our revenue that we keep post expenses. If we take our profit and we use the equation we built earlier, we can simplify it into the price per unit minus the variable cost per unit multiplied by the quantity minus our fixed costs. And then we can simplify revenue into our price per unit multiplied by our quantity. If we walk through an example where in our lemonade stand we sold 20 cups of lemonade, we can calculate our $1 contribution margin multiplied by our 20 cups of lemonade, subtract our $10 for our poster, gives us a profit of $10 over our $40 of revenue, or $2 per cup multiplied by 20 cups of lemonade, implying a profit margin of 25%. An important thing to understand about profit margin is that it's variable by industry, with some industries achieving very low profit margins and some industries achieving very high margins. An easy way to think about it is that the more an industry is differentiated, the higher profitability it will be. And the more it is a commodity, so think maybe rice or soybeans or wheat, the less profitability will be in that industry. And a common framework to think about profitability is Porter's 5 forces, which is typically the standard for understanding the profitability of an industry. This is one of many frameworks you'll likely hear discussed in consulting case prep, but one I find is often hard to directly plug into an individual case, but is helpful for understanding what are the enablers like barriers to entry, bargaining power of suppliers, bargaining power of buyers, threat of substitute products, or competitive intensity within an industry will help you gauge and understand the profitability of an industry without actually having to walk through every single step of that framework. You'll hear of many of these. You'll hear of the 3 C's or the 4 P's or many different ways to think about market profitability or strategic situations that you can use as a framework. There are many, many different types of cases you will encounter throughout the case interview process, but they're all derived from the same profitability framework. You can have very simple profitability cases where you have a company that is declining in profitability. How should we go and fix that? And you'll walk through revenue minus costs, maybe a profit margin calculation, maybe calculate the break-even point, and walk through that structure very, very seamlessly and similar to how we did in this video. Or there'll be some that are more nuanced and more focused on different aspects of the profitability formula. Market sizing exercises, which are gauging the profitability implications of entering into a specific market. Capacity expansion, which gauges, is it profitable to open a new warehouse? Your client is simply thinking, what are the profitability implications of investing $1 million into a new factory or a product line adjacency? If you're thinking about entering into another market that is similar and adjacent to your existing core product suite, what are the profitability implications for entering into that product line? If you're doing a valuation case, you're simply valuing the present cash flows and the future cash flows to understand what is the expected profitability of this strategic decision. What should we bid on this asset? This could be a pricing case where you're trying to price a product to maximize profitability. This could be cost reduction where you're focused on bringing down costs to maximize profitability. This could be sales force optimization. You are trying to pick the sales option that has the greatest profitability impact or the greatest amount of revenue uplift with the least amount of cost. Everything comes back to this simple profitability framework. So understanding it really well and understanding how revenue and costs work together, how price and quantity work together will be really, really important and will be helpful as you think about other types of cases and how they fit into this overall framework. If you have enjoyed this content, thank you for joining us at Essentials Explained, and please check out the other consulting content we have in this playlist and on our channel.